For centuries, money has always migrated toward the most powerful form of leverage available in a given era. Empires were built on control of land, then on control of trade routes, then on industrial capacity, and later on information networks. Each transition felt chaotic to the people living through it. Old professions weakened, new fortunes appeared almost unfairly fast, and many observers dismissed the transformation as temporary hype. Yet when historians look back, the pattern becomes obvious. Capital consistently flows toward systems that multiply human capability. Artificial intelligence represents the next multiplication engine. But unlike previous technologies, AI does not merely extend muscle or improve communication. It amplifies cognition itself. Decision-making, pattern recognition, forecasting, optimization, tasks that once required years of training and entire departments can now be executed, assisted, or sometimes replaced by algorithms operating at extraordinary speed. This shift is not incremental. It changes the economics of how value is produced. When intelligence becomes partially automated, output per worker rises. When output per worker rises, margins can expand. When margins expand, valuations adjust. Markets may argue about timing, about regulation, about ethical constraints, but they rarely ignore structural profitability for long. This is why the AI wave is financial before it is philosophical. Investors are trying to calculate who will own the infrastructure of intelligence. Who supplies the compute? Who controls the data? Who builds the models? Who distributes the applications? These layers resemble the railroads, refineries, and fiber cables of previous revolutions. They are the foundations upon which new business ecosystems grow, and foundations tend to capture durable value. Consider how corporations traditionally scaled. Growth required hiring. Hiring required training. Training required time. Organizations accumulated bureaucracy because complexity increased with size. AI compresses this relationship. A smaller, more agile company equipped with advanced automation can compete with giants by deploying software instead of expanding payroll. The constraint shifts from labor availability to access to capital and technology. From a market perspective, that is explosive. Barriers to entry fall in some areas while rising sharply in others. Creative destruction accelerates. Competitive advantages become more dependent on proprietary data, specialized hardware, and integration depth. Investors who understand where defensibility is forming may identify opportunities that remain invisible to the crowd. Yet enthusiasm alone is not a strategy. Every cycle produces exaggeration. During the railway boom, investors believed every track would generate riches. During the internet expansion, it seemed every website would dominate global commerce. Reality sorted winners from dreamers with brutal efficiency. I will likely experience similar phases of overconfidence and disappointment. But temporary mispricing does not cancel structural direction. Even if individual companies fail, the aggregate demand for machine intelligence is likely to grow. Governments want smarter defense systems. Hospitals want better diagnostics. Logistics networks want optimization. Financial institutions want risk modeling. Consumers want personalization. The incentives are universal. Better decisions, faster. As long as those incentives remain, investment will continue. For retail participants, the challenge is psychological endurance. News cycles amplify fear during corrections and amplify greed during rallies. Social media compresses attention spans, encouraging short-term thinking in an environment that rewards long-term positioning. The temptation is to react constantly rather than to prepare deliberately. Preparation looks boring. It involves studying balance sheets, understanding supply chains, learning how revenue concentration creates vulnerability, and recognizing how capital expenditure today may translate into competitive strength tomorrow. It requires accepting uncertainty while still acting rationally within probabilities. This temperament has historically separated durable investors from temporary speculators. Another important dimension is time horizon. Transformations of national infrastructure rarely complete in a year or two. Electricity, automobiles, and the internet required decades to diffuse fully across society. Early volatility masked immense eventual expansion. Those who survived the turbulence participated in compounding that, in hindsight, appears extraordinary. I may follow a comparable trajectory. Short-term narratives will fluctuate. Breakthroughs will alternate with setbacks. Regulations will tighten, then loosen. Market leadership will rotate. But the integration of automated intelligence into daily economic life seems increasingly irreversible. And irreversibility is powerful. When businesses design processes around new technology, reverting becomes expensive. Skills adapt, supply contracts evolve, and customer expectations shift. Over time, adoption becomes embedded not because it is fashionable, but because it is necessary for competitiveness. This is how revolutions mature. So the question becomes not whether AI will matter, but how participation should be structured. Concentrated bets may deliver dramatic outcomes, positive or negative. Broader exposure across the ecosystem may sacrifice headline excitement, but improve survival probability. Each approach reflects different tolerances for volatility, liquidity needs, and emotional resilience. There is no universal formula. However, history consistently rewards those who align with productivity growth while maintaining risk discipline. Excessive leverage tends to punish impatience. Diversification, though sometimes criticized during speculative manias, often proves invaluable when conditions reverse. Rational optimism may be the most sustainable posture. To recognize opportunity without denying uncertainty. To build positions gradually. To maintain reserves for unexpected dislocations. To remember that technological acceleration and market pricing rarely move in perfect synchronization. Moments of divergence create entry points. We are witnessing the early architecture of a system that could redefine global competitiveness. Nations are investing billions. Corporations are reorganizing strategies. Universities are reshaping curricula. Talent is migrating toward data science, engineering, and computational research. Capital follows this migration because future cash flows are expected to emerge from these concentrations of expertise. Whether expectations become excessive at times is almost secondary. The gravitational pull toward intelligence enhancement appears durable. For individuals, managing portfolios, the opportunity lies in remaining informed, flexible, and patient enough to let structural forces operate. Predicting exact quarterly outcomes is extraordinarily difficult. Participating in multi-year transformation is challenging, but historically achievable for disciplined investors. The monetary era shaped by I will reward preparation more than prediction. Those who continually educate themselves, who resist emotional extremes, and who understand that volatility is often the price of admission to growth may find themselves positioned not perfectly, but sufficiently. And in long-term investing, sufficient can be extraordinary.